This is Aditya Dhingra presenting the semi-final submission for Team Meraki in the Accounting for Sustainability International Case Competition 2021. Our idea centers around building anti-fragile supply chains using insurance contracts that promote knowledge and risk sharing across stakeholders in the chain. This is a shift from the conventional view of supply chain insurance, whereby organizations are hardly in contact with their third or fourth degree suppliers or distributors. Antifragility is a property of systems in which systems increase in performance measures in response to negative stressors. For antifragility to emerge naturally in a system, certain prerequisites are essential, such as a convex response. In a crude sense, a convex response basically means decreasing sensitivity to higher volatility of an external shock. Secondly, learning through feedback. This essentially means, in our context of supply chains, that there is information sharing and complete transparency of information across the supply chain. Our supply chains, which have been based on a lean manufacturing philosophy, are today more fragile than ever. We have shorter product and technological development cycles and low excess capacity because the trend is to not keep any buffer inventory because it creates inventory management costs. Second, there are large balances of inefficient trade credit between suppliers and distributors. What do we mean by this? For example, let us take the example of General Motors. A large distributor or manufacturer like General Motors can bully its suppliers and distributors into providing favorable terms of trade credit. This means lower interest rate, and these small entities are not financial institutions and they cannot manage credit risk. Thus, by squeezing them, General Motors is creating fragilities within the system which will harm it in the long run. Second, management inefficiencies. Executives are not well equipped to understand the business models of the various stakeholders in the supply chain. They are not able to underwrite effective supply chain risk contracts which contribute to risk and knowledge sharing across the chain. Coordination problems. Supply chain investments typically require coordinated investments across the chain. And the benefits of these coordinated investments are typically not symmetric or not equitable. They are reaped by We propose a learning oriented supply chain contract which indemnifies direct participants across an entire chain as opposed to individual nodes against the following operational risks. For the internal perils, we cover procurement risk, transportation and information risk, and for external perils, we cover natural disaster, terrorism, geopolitical, trade, and environmental policy perils. Unlike ordinary insurance products, which include certain deductibles and leave the insured marginally worse off to minimize agency conflict, this contract assists the entire supply chain, enhance the performance post a risk event through knowledge sharing and coordination of investments into supply chain infrastructure that embeds circularity. We set the following objectives for our product to deliver. The size of the global supply chain insurance market is grossly underestimated. This is because, according to surveys, 9% of managers are familiar only with their immediate tier 1 partners and know very little about partners beyond. Only 9% of managers say their organization can assess the impact of disruption in a matter of hours. 17% say it takes 3 weeks or longer. 48% say they will regionalize or localize supply chains to improve the management of their supply chain risk. And finally, traditional supply chain insurance only covers 60% of all disruptions, as it does not extend to second and third tier suppliers, which account almost for 30% and 10% of all disruptions, respectively. Across all industries, we target global supply chains of high complexity, comprising automakers, retailers, distributors, vendors, and warehouses. Our target industries include pharmaceutical, consumer staples and discretionary, industrials, materials, and agriculture, basically the manufacturing sector and the agricultural sector. We estimate the total addressable market to be around $40.67 billion. This first step will involve the analytical due diligence, identifying critical supply points and mapping critical relationships. If the organization is highly outsourced, it would be important to understand the impact of supplier insolvency on the business. If the company is highly internalized with many of its own owned manufacturing dependencies, it would be more relevant to model critical machinery failure. The second step involves overlaying into supply maps and assigning VARs, reducing a huge supplier base to a manageable number of suppliers by applying criteria such as single points of failure, uniqueness of component, control of key intellectual property, etc. The third step involves contingent business interruption quantification. This involves quantification of the risk of business interruption by external events. Starting the process with internal manufacturing sites and tier 1 suppliers, and then gradually moving deeper up the supply chain where vulnerabilities are revealed. The next phase involves risk auditing. In addition to conventional risk auditing for a single insured firm, we must implement the following investigations. From the insurer's perspective, there is increased confidence that operational mitigations have been applied where possible and only residual risk is being transferred. There is also greater confidence that actual exposures are reported rather than pure gross profits, and consequently, the ability to track aggregations is vastly improved. Strong supply chain risk management reassures the insured of the optimum insurance buying decisions. The right cover is being purchased at the right attachment point and limit. Next, we invite stakeholders across a global value chain to understand individual risk appetites, knowledge, and information asymmetries. Following that, we understand the individual risk management systems in place. After this understanding is developed, we study the interrelationships. We locate fragilities such as excessive concentrations of inefficient trade credit in the capital constrained organizations. For example, big manufacturers often bully suppliers and distributors into cheap trade credit terms. While minimizing cost, it creates fragility as suppliers are not financial institutions with capabilities in credit risk management. Thus, the failure of the second party harms the entire chain, including the manufacturer in the first place. The next phase involves insurance underwriting and the incentive restructuring. Writing a contract with each firm individually and insuring against information risk due to leaks of proprietary knowledge capital. This encourages some degree of self insurance also, facilitating the shift to circular supply chains. This is done by coordinating investments across the chain for setting up remanufacturing capabilities. This is only possible if we have an incentive structure which facilitates coordinated action. The next phase involves pooling of the expected losses, where we insure losses across geographies to minimize geographical concentration of risk in industries where industries have consolidated to specific geographies, and ensuring losses across different industries to diversify exposures across supply demand shock of individual markets. Investment strategy for premiums. We've implemented the following hedging and investment strategy for the premiums collected. Geopolitical risk is hedged through precious metals. The risk of natural disasters is hedged by purchasing credit default swaps on catastrophe bonds and currency derivatives on nations with high exposure to black swan events of natural origin. Investments in uncorrelated assets, private equity, and hedge funds. And finally, the ordinary institutional investments typically undertaken by reinsurance firms. The next discussion would point towards contract pricing. Since circular supply chains reduce sourcing risk, a major component of supply chain risk, premiums will reduce over time to create incentives. To ensure that savings from remanufacturing are distributed fairly, two-way chains create new means of exchange other than cash or debt. Our product creates environmental impact directly and indirectly. First of all, premiums are invested into high ESG public and private equity and debt vehicles. Typically, these private equity allocations will comprise around 5 to 10% of total capital allocation, and the liquid assets with ESG ratings will comprise around 30 to 40% of minimum capital allocation at any point of time. In terms of real impact, our product unlocks the circular economy market by transitioning away from the linear economy chains by creating suitable incentives to create this transition over the course of time.